What is a trust fund? Hi there, it's Luigi, and welcome to Catapult Capitalism, your guide in making smart financial moves for your future. If you enjoy watching our videos, feel free to like, subscribe, and hit that notification bell so you get updated whenever we upload a new video. In today's video, we are going to explain to you what a trust fund is. So if you're into these kinds of videos, then keep on watching. What is a trust fund? A trust fund is an estate planning instrument that creates a legal entity to hold property or assets for an individual or organization. Trust funds can contain money, real estate, stocks and bonds, a company, or a mix of many various sorts of properties or assets. A trust fund must be established by three parties: the donor, the beneficiary, and the trustee. Trust funds can take several forms and can be formed under various conditions. They provide tax advantages as well as financial protection and assistance to people who participate. Estate planning is the process of arranging how an individual's assets and other financial issues will be managed, as well as how any property they own will be dispersed after their death. Bank accounts, investments, personal property, real estate, life insurance, artwork, and debt are all included. While wills are the most prevalent estate planning vehicle, trust funds are also often used. The following three parties are involved in establishing a trust fund. The grantor or donor establishes it and populates it with their assets. The beneficiaries or individuals for whom the assets are handled. The trustee is a neutral third party, either a human, a trust bank, or another professional fiduciary who is in charge of managing the assets involved. The grantor usually makes an arrangement that is carried out when they are no longer mentally competent or living for a number of reasons. The trustee is responsible for carrying out the grantor's interests as the appointed fiduciary. While they are alive, this generally entails assigning living expenditures or even educational fees such as private school or college tuition. Alternatively, they might pay a lump payment straight to the recipient. Trust funds offer significant advantages and safeguards to individuals who establish them as well as their beneficiaries. As an example, some kinds can keep assets out of the reach of creditors if they chose to pursue the grantor for outstanding obligations. They prevent the necessity for probate, which is the process of assessing and distributing assets when a person dies without leaving any instructions. After the grantor dies and the assets are given to the beneficiary, some trust funds can minimize the amount of estate and inheritance taxes required. After the grantor dies, an estate tax is paid on the value of the estate, whereas inheritance taxes are assessed on the entire amount a beneficiary gets from an estate. Particular considerations. When millions or perhaps billions of cash are at risk for numerous generations of a family or other institution, wealth and family arrangements can get rather difficult. As a result, a trust fund might have a startling number of options and specifications to meet the interests of a donor. But contrary to popular belief, trust funds aren't solely for the super rich. In fact, they may be beneficial to almost anybody, regardless of financial status. Revocable trust funds versus irrevocable trust funds. Trust funds fall into two different categories: revocable and irrevocable trust funds. The following are brief descriptions of the two. Revocable trust fund. A revocable trust fund allows a grantor to have more control over assets during his or her lifetime. Following assets are deposited in it. They can be distributed to an unlimited number of selected beneficiaries after the grantor's death. It can be used to transfer assets to children or grandchildren. It is also known as a living trust fund. The key advantage is that the assets are not subject to probate, allowing for the fast transfer of assets to the named beneficiaries. Because living trust monies are not made public, an estate is allocated with great discretion. Changes can be made while the grantor is still alive, and they can also be completely cancelled before the grantor dies. Irrevocable Trust Fund. It is extremely difficult to amend or cancel an irrevocable trust fund. Because of this arrangement, the grantor may reap significant tax savings by essentially transferring ownership of the assets to the trust fund. Irrevocable trust funds are frequently used to avoid probate. Types of trust funds. Revocable and irrevocable trust arrangements are further subdivided into different trust funds. Depending on the assets involved and, more significantly, the beneficiary, these types frequently have distinct regulations and limitations. Understanding the complexities of any of these vehicles may require the assistance of a tax or trust attorney. Keep in mind, though, this is not a complete list. Asset protection. This fund shields a person's assets from future demands by creditors. Blind. This fund strives to eliminate any appearance of a conflict of interest. As a result, the donor and beneficiary of the trust fund have no awareness of the holdings or how they are handled. It does, however, give the trustee control. Charitable. A trust fund that supports a specific charity or the broader public. A charitable remainder annuity trust, or CRAT, is one type of trust that pays a fixed sum each year. A charitable remainder unitrust transfers assets to a designated charity when the trust fund ends and provides the donor with a charitable deduction as well as a fixed proportion of income to the beneficiary over the trust fund's term. Generation skipping. This one includes tax advantages if the recipient is one of the grantor's grandchildren or someone at least 37 years younger than the grantor. Grantor retained annuity. Creating this sort of fund allows the grantor to pass any asset appreciation to any beneficiaries in order to reduce inheritance taxes. Individual retirement account. IRA disbursements are controlled by the trustees rather than beneficiaries. Land. This enables the administration of property such as land, a house, or another sort of real estate. Marital. This is financed upon the death of one spouse and is qualified for the unlimited marital deduction. Medicaid. This program was created to allow individuals to set aside assets as gifts to their beneficiaries, allowing the grantor to qualify for Medicaid long-term care. Individuals might transfer their personal residence from their estate to this sort of fund in order to lower the amount of gift tax owed. Qualified terminable interest property. This one benefits a surviving spouse but gives the grantor the authority to make choices after the surviving spouse's death. Special needs. People with special needs are the beneficiaries so that they are not disqualified from receiving government assistance. Spendthrift. Beneficiaries do not have direct access to the listed assets, which means they cannot sell, spend, or give away the assets unless certain conditions are met. Testamentary. Following the death of the grantor, assets are left to a beneficiary with precise instructions. What is a trust fund baby? A trust fund baby is a child whose parents established a trust fund in their name. The word is a well-known cultural allusion that is frequently used negatively. The statement implies that recipients are born with silver spoons in their mouths, are unduly fortunate, and do not need to work to survive. It is true that trust funds can give security to beneficiaries. However, many so-called trust fund infants or babies do not live in luxury or in high society. How do trust funds work? Trust funds are legal organizations that offer individuals financial, tax, and legal security. They necessitate the presence of a grantor who establishes it, one or more beneficiaries who get the assets after the grantor dies, and a trustee who oversees it and distributes the assets at a later period. Trust monies are intended to carry out the grantor's desires. This implies that the trustee is responsible for managing the assets while the owner is still alive. Following their death, the trustee can distribute the assets to the beneficiaries in accordance with the grantor's wishes, whether through a regular income stream or a lump sum payment. How can I establish a trust fund? To set up a trust fund, you must first choose which one is most suited for you. So make sure you determine the specific objective of the fund. Then, decide how you're going to fund it. Determine who you want to be your trustee. This individual may be able to assist you in drafting all of the necessary paperwork and navigating the legal system. The trust fund must now be funded. As with any other financial decision, make certain that a trust fund is the best option for you, your recipient, and your financial condition. And that's it for this video. If you enjoyed it, don't forget to like, subscribe, and hit that notification icon. Thank you so much for tuning in to Catapult Capitalism, and we'll see you later.